The father of technical analysis, Charles Dow, introduced a theory in the year 1900. The Dow theory, through which people could actually predict what was going to happen in the market. Even though today's YouTube trading channels may not talk about this, this strategy is still just as effective as it was 100 years ago. And this strategy is driven by the same theory, which is called multi-time frame analysis.
Are you ready? Profit secure. American Sniper. Precision Trading. EA.
Today, we are going to learn about a trading concept that, if you master it, will change your trading style forever. In this video, I will explain how you can analyze charts from higher time frames to lower time frames and improve your trading decisions. So first, let's understand what multi-time frame analysis is. This is a method of analysis in which you first analyze the higher time frame and then gradually move down to the lower time frames. In this process, there are three important. A complete time frame is required. The first time frame is the direction time frame, which you use to understand the direction of the market. That is, you observe whether the price is going up, going down, or moving sideways, which gives you an idea of the overall trend. The second time frame is the behavior time frame, which explains the price behavior in detail. This means you look at the price momentum, whether the market structure is breaking or not, whether weak rejections or doji candlesticks are appearing, and whether the market is retracing or not. The third and final time frame is the entry time frame, in which you actually enter the trade. If the price is in a downtrend, you will look to sell, and if it is in an uptrend, you will look to buy. It's very simple. The time frames you use depend on your trading style. Suppose I use a mix of intraday and swing trading, then I use the 4-hour time frame for direction. I use the 1-hour time frame for behavior and the 15-minute time frame for entry. But if you are trading on a different scale, these time frames will be different for you. You will use the 1-hour time frame for direction, the 15-minute time frame for behavior, and the 5-minute time frame for entry. That's why the time frame completely depends on your trading style. But I have explained with an example so that you can choose the right time frame according to your trading style. Let's start multi-time frame analysis, in which we will first select the 4-hour time frame so that we can find out which direction the market is currently moving in. The biggest reason for choosing the 4-hour time frame is that it gives us the complete structure of the market and tells us which direction the market is currently heading in. If we used a 15-minute chart, we wouldn't be able to determine the clear direction because the price keeps moving up and down, up and down. That's why, to understand the direction, it's always better to look at a larger time frame. Most of you might get confused looking at this chart, wondering what the price is doing here and how we should take a trade. Should we buy? Should we sell? Or should we not trade at all right now? But this is the wrong way to look at charts. Because if we are intraday or swing traders, we shouldn't be looking at very old charts. We need to observe how the market price has been behaving recently. If we start doing this, there will be too many support and resistance lines on our charts, making your chart very complicated, and you won't be able to make trading decisions. Just think, if there are so many lines on your charts, how will you understand what the price is doing at the moment? On the 4-hour time frame, our chart is clearly showing a strong uptrend, and at this moment, the price is consolidating. First, we will mark the high of this consolidation zone, and then we will mark the low of the consolidation zone. By drawing these two lines on the charts, we will wait. First, we will let the market decide which direction it wants to go in. At this time, the market can go either way. It can either continue its trend or it can reverse down from here. If I were in a live trade at this time, I would first wait for the candlestick to close outside these two lines on the 4-hour time frame. Only then would we decide whether to buy or sell. In the next few candles, the price closes a candle below the lower low. At such times, most new traders enter a sell position. I want you to pay close attention to what the price does after this. In the very next candle, a big green bullish candle forms. Now, what I'm about to tell you, listen to it carefully, because this could change your trading style forever. I'm giving you a secret tip, absolutely free. Right now, the charts are on the 4-hour time frame, and we can see that this is a strong uptrend. But as soon as we switch the charts to the 1-hour time frame, we see that the price is gradually moving downward. And when we change the 1-hour time frame to the 15-minute time frame, we see a strong downtrend on the charts. This can confuse you because on the 4-hour time frame, the price is showing an uptrend, But on the 1 hour and 15-minute time frames, the price appears to be in a downtrend. Let's understand why this is happening. When the price was on the 4-hour time frame, in the last few candles, the price was undergoing a retracement or pullback. When we look at this pullback on a smaller time frame, it appears to us as a downtrend. Always remember one thing: the higher time frame is always stronger than the trend on the lower time frame. In this situation, the 4-hour time frame will be stronger than the 1-hour time frame and even stronger than the 15-minute time frame. That's why we will take trades only in the direction of the trend on the higher time frame. Since the trend on the 4-hour time frame is an uptrend, we are going to take a buy position. Right now, the chart is on the 15-minute time frame, and on this chart, we should not enter a buy trade immediately because the price momentum is still towards the downside. First, we will wait for the price to shift from a bearish to a bullish trend on the 15-minute time frame. Only then will we enter a buy position. So far, the price is not giving us any signal that it is about to turn bullish, so we will continue to wait. The price comes to retest this level, but it is unable to break it completely and goes down again. This happens again, which tells us that the price has now gone sideways. At this time, it is necessary for the price to close above this level and form an uptrend structure in order to enter a buy position. If we switch the price to a 1-hour time frame, we can see that so far, we are not getting any bullish signals on the charts that would allow us to make a buy decision. In the next few candles, the price comes down to the last swing low and then takes a strong rejection from that particular level, moving upwards and forming a big green bullish candle. The price has broken the trend line, but we do not want to take a trade entry on the 1-hour time frame. That's why we are switching our charts to the 15-minute time frame. Now we can say that the momentum has shifted from a downtrend to an uptrend, and at this moment, the momentum is up in the 15-minute time frame. Momentum is up in the 1-hour time frame, and finally, momentum is also up in the 4-hour time frame. When the momentum is in the same direction across all 3 time frames, you can consider your setup to be ready, and this is nothing short of magic. Always remember, you should never trade in haste. We should wait until the price is moving in the same direction on all 3 time frames. Now here, we enter a buy position in the trade, right at the closing of this joint green candle, where our stop loss will be set just below the trend line. In this trade, our target level will be the swing high on the 4-hour time frame, because it was from this level that the price started to shift towards a downtrend. You can also call this the supply zone or resistance area. If you are confused about setting the target, let me give you a tip. Before entering a trade, you should pay attention to the left side of the charts and see at which levels the swings are. For example, last time this was a swing high, and before that, this was also a swing high. So at this time, we can set 2 targets. But since the trend is strong on the higher time frame, it is better to set the swing high as the target. And look, the price shot up without wasting any time. Let's shift the time frame from 15 minutes to 1 hour. Now the price is near its high, and if you enter a buy position here, your stop loss will have to be set quite low, which will ruin your risk-reward ratio. That's why we shouldn't enter the trade immediately. Instead, we should let the price retrace to this level first. The price comes down forming a red candle and touches this level, but you can't enter here immediately. If you enter here, you're just guessing that the price will go up. But price is very unpredictable. No matter how important a level is, it can always be broken or the price may not respect that level. That's why we wait for the market to confirm which direction it is going to move in. Only after that will we enter the trade. If you trade according to your own wishes, then this is a dangerous. You can never survive in the market, no matter how much capital you have. At most, it will take a week, and your capital will be wiped out. That's why you should always wait for confirmation. Now, let's shift the price to the 15-minute time frame. If you see that the price is still in a downtrend, then we shouldn't do anything. It is important to wait until the price closes above this level with a strong green candle. Once again, the price breaks the previous swing low, and in the next few candles forms a strong green candle moving upwards and closes strongly above this level. Here, there is a reason why the price reversed from this particular level. As soon as we shift the charts to a higher time frame, a demand zone appears on the left side of the charts. How do we draw supply and demand zones here? We won't discuss this because I have already made a detailed video on this topic. You can go to the channel and watch that video. I want you to observe this situation carefully and connect it to the video I made earlier. Now, we have 3 confirmations. First, the trend is up on the 15-minute time frame. Second, the trend is up on the 1-hour time frame. And third, the price is also up on the 4-hour time frame. We know that this setup works like magic for us. We will enter a buy trade at the closing of this candle, with our stop loss near the candle's low, and take profit at the next swing high. If we look at the higher time frame, this is our key level up to which the price can go. You can see that the price behaves exactly like that. Gradually, forming a market structure, it moves upward and touches that level. Gradually, as the market structure forms and moves upward, it touches that level, which hits our target and allows us to book our profit. This trading strategy works best for me because I am both an intraday and a swing trader. However, when you use this strategy, you can change the time frame according to your own trading style.